Welcome to another exciting episode of Trader DNA. If you can spot order blocks but still find yourself losing trades, the issue might not be with the order blocks themselves. Instead, it's likely because you don't yet know the exact spots to open your positions within your order block trading strategy. This is where most traders stumble. Figuring out the right entry points from the order block patterns can feel like trying to decode a cryptic map. That's why in today's episode, we're diving deep into the solutions. To kick things off, because this is absolutely crucial, we're going to revisit a real-life trading scenario on this 15-minute chart. This is the same setup I broke down in last week's video, and today we're diving even deeper to uncover every key detail. So, gear up traders, let's dissect this trade together and uncover the insights that can sharpen your edge in the market. On the screen we have a chart set to a 15-minute time frame. As you can observe, the overall market trend is clearly in an uptrend. A closer analysis of the chart reveals that the price has created a bullish structural breakout by breaking and closing above a key high point, signaling a potential shift in market dynamics. This break of structure BOS prompts us to turn our attention to locating the order blocks associated with it. The red candle at the extreme represents the final bearish candle that appeared before the price began its significant upward push. This candle successfully swept the liquidity below the preceding one. However, upon closer examination, it becomes evident that this candle's order block is mitigated by the presence of a small upper wick. As a result, this particular order block does not meet the criteria to be deemed valid. If we look slightly higher on the chart, we can identify another bearish candle, which stands out as the last bearish candle before the price makes a significant upward push. A closer inspection reveals that this particular candle successfully breaks through the low of the preceding candle, demonstrating its importance in the structural movement. When we highlight this candle, it becomes evident that its order block is mitigated by the upper wick of the following bullish candle. When the order block we identify is mitigated by the last candle within a series of 3 candles, our focus should shift to the next candle as the valid order block. Therefore, this specific candle becomes our valid order block, forming the foundation for a potential trading opportunity. As we proceed to the next sequence, we notice that the price initiates another upward movement, continuing its bullish trajectory. Within this movement, we can spot a bearish candle, which is significant as it represents the last bearish candle before the price pushes strongly upward. Upon closer examination, we see that this candle has broken below the low of the preceding candle, signaling a potential shift in liquidity. However, when we highlight this candle, it becomes apparent that it is mitigated by the wick of the third candle in the sequence. This observation aligns with the scenario we discussed earlier, where a mitigated order block cannot be considered valid. Consequently, our attention shifts to the next candlestick, which we identify as the valid order block to focus on for potential trading opportunities. Here, traders, we encounter a hammer pattern, which we identify as our valid order block. However, upon further observation, we notice that while the price initially reacts to this area with a brief touch, it ultimately pushes lower, failing to respect the order block as anticipated. The primary reason for this behavior lies in a critical rule. We must always wait for the price to clear inducements before placing any buy or sell orders. This principle ensures that the market structure aligns with our strategy and minimizes the risk of premature entries. As the price action unfolds, we observe that it continues its downward momentum before entering our identified valid order block. Upon reaching this level, the price experiences a reversal and begins to push higher. If we were analyzing this on a live chart, this scenario would present an excellent opportunity to execute a long position and strategically enter the market. Following this movement, the price forms a character change pattern, signified by a break and close through the market structure. This shift in behavior is a critical indicator that the market dynamics are transitioning. After such a character change, it becomes essential to exercise patience and wait for the price to clear any existing inducements before making a decision to initiate a long or short trade. In this example, the low of the highlighted candle marks the most recent internal level created by the price as it moves upward. Once the market clears this inducement, the logical next step is to anticipate the price's return to the valid order block we identified earlier, ensuring alignment with our trading strategy. In this particular setup, we can identify the white candle as the final bearish candle formed immediately before the price makes a dramatic upward push, sweeping liquidity beneath the low of the preceding candle. Notably, there is also a visible imbalance present above this candle, further validating its significance. For these reasons, this candle qualifies as a valid order block, offering a high probability setup should the price retrace. If the price revisits this level and taps into the order block, it provides a compelling opportunity to consider entering the market with a long position. Traders, we've now covered the essential concepts of identifying the primary order blocks that commonly appear on real price charts. This discussion equips us with a solid foundation for recognizing these key zones and understanding their significance in market movements. In the next section, we will delve deeper into various entry models that can be seamlessly integrated into your trading plan, leveraging the insights gained from order blocks. Order block entry models. When it comes to trading with order blocks, selecting the right entry model can make all the difference. These entry strategies are powerful tools designed to help you execute trades effectively based on the insights derived from analyzing order blocks. Let's start by exploring the first entry method, the wick entry. This technique is straightforward yet highly strategic. Once you've identified a valid order block, you simply place your buy or sell order directly on the wick of the candle. For a sell position, for instance, the stop loss is placed a spread size above the higher wick of the order block. While this approach provides a broader stop loss margin which can slightly reduce the reward to risk ratio, it significantly increases the likelihood of your order being triggered. Why? Because prices often touch the wick before reversing in the anticipated direction. This makes the wick entry method an excellent choice for traders aiming to capture moves right from the zone of interest. By carefully applying this strategy and considering the underlying market conditions, you can gain a strong edge in your trading. The body entry method. The second entry type we'll explore is known as the body entry. This method takes a slightly different approach to order block trading, offering its own unique advantages and trade-offs. Here's how it works. Once you've identified a valid order block, your entry point is placed at the body of the candle rather than the wick. For sell positions, the stop loss is strategically positioned a spread size above the higher wick of the order block. This entry method is particularly appealing because it typically delivers a higher reward to risk ratio compared to the wick entry. Why? The stop loss margin is tighter, meaning your potential risk is reduced while the profit potential remains strong. For traders looking to maximize their returns on well-analyzed trades, the body entry can be an excellent choice. However, as with any strategy, this approach isn't without its risks. By placing the entry at the candle body, you introduce the possibility of price interacting only with the wick of the order block before reversing in your anticipated direction. In such cases, your order may not be triggered at all, resulting in a missed opportunity for what could have been a highly profitable trade. While the body entry method demands precise analysis and an understanding of price behavior, it's a powerful tool for traders who can manage the trade-offs effectively. The midpoint entry method. The third type of entry, and one that I personally favor and frequently incorporate into my trading plan, is known as the midpoint entry. This method involves placing your trade entry at the midpoint of the order block zone after identifying a valid order block. Its precision and efficiency make it a standout choice for traders aiming to strike the perfect balance between risk and reward. In a bearish scenario, the stop loss is placed strategically, a spread size above the highest point of the order block. This thoughtful positioning ensures that your risk is tightly managed while leaving room for the trade to play out as anticipated. One of the key advantages of the midpoint entry is its superior reward to risk ratio, which is typically at least double that of the other entry methods we've discussed. This significant edge stems from the combination of a refined entry point and a smaller stop loss margin, allowing for greater profit potential with reduced risk exposure. It's precisely for these reasons that this entry type holds a special place as my go-to strategy. By adopting the midpoint entry method, traders can enhance the overall profitability of their trades while maintaining effective risk management, a winning combination for any trading approach. The fourth entry type, the body placement within the order block zone. The fourth and final entry type involves a bold approach, placing your trade entry based directly on the body of the candle after identifying a valid order block. While it shares some similarities with other methods, its distinct characteristics make it both unique and demanding for traders who choose to adopt it. For sell positions, the stop loss is set strategically, touching the higher wick of the order block. This creates a tighter risk margin, but also positions the stop loss within the order block zone itself. This detail is what sets this method apart and makes it inherently riskier than the previous types. Here's why. If the price decides to fully reverse through the order block, the stop loss will likely be triggered, potentially resulting in a loss. This increased exposure to risk requires traders to carefully assess the market conditions and weigh whether this entry method aligns with their overall strategy. It's crucial to recognize that this approach isn't for the faint of heart. While it can offer opportunities for tighter stop loss levels and potentially higher reward to risk ratios, the elevated risk demands sharp analytical skills and disciplined execution. For traders willing to embrace the challenge, this method can be a valuable addition to their arsenal. That's it for today, traders. Thank you so much for tuning in to this video. I truly hope you found it both informative and valuable for enhancing your trading journey. Every tip and strategy we share is designed to empower you to make smarter, more confident decisions in the Forex and stock market. Before you go, don't forget to hit that subscribe button and turn on notifications so you'll never miss out on our latest videos packed with powerful insights and strategies. Your trading success is our mission, and staying connected ensures you're always a step ahead in the game. We also value your thoughts and ideas, so please take a moment to share your feedback in the comments below. Let us know what topics or strategies you'd like us to dive into in future episodes. Your input helps us create content that's tailored to your needs and interests. Thank you for your incredible support, traders. It means the world to us. Stay sharp, stay focused, and we'll see you in the next episode with even more trading wisdom to elevate your skills. Until then, happy trading.